Good morning, everyone, and thank you for joining our Junior Energy In-House Lawyers webinar series. For today's webinar, we're going to focus on warranty and indemnity insurance, or in other words, W&I insurance. My name is Sarah, and I'm a senior solicitor in the energy team focusing on corporate matters. I am one of today's speakers, and I'm joined by my two of my colleagues, Emily and Rebecca, who are also members of our energy team. Before we get started, just a little bit of housekeeping. Once you've joined, please ensure that your mute button has been selected to limit background noise. Please note that today's webinar won't be interactive, so please do contact Emily, Rebecca, or myself if you have any questions after today's session. Our contact details will be available at the end of the slides. Today's webinar will be recorded, and if you have any queries on that, please do check out our privacy policy, which is available on our website. I'll now introduce you to Emily, who will tell you what we're going to cover in today's session and kick us off.
Thanks, Sarah. So what we're going to cover in today's session includes an overview of what warranty and indemnity insurance is, strategic reasons for using W&I insurance, conducting a deal with W&I, the importance of due diligence, some interactions with the share purchase agreement, completion considerations, and key considerations for W&I in the energy sector, and we'll finish off with some market insights. So let's start with the basics and what W&I insurance is. W&I insurance is a specialised insurance policy used in M&A transactions to protect against financial losses arising from breaches of warranties given by the seller. Importantly, although we use the term warranty and indemnity insurance, the insurance generally doesn't cover indemnities. W&I insurance provides coverage for unknown issues and not known issues discovered throughout diligence. If there is a known issue, the seller would often be looked to for a specific indemnity, or there would need to be specific cover negotiated with the insurer. The purpose of W&I is to transfer the risk of unknown liabilities from the seller or buyer to an insurer, with the seller's liability being capped at £1, save for instances of fraud and any exclusions. In the event a loss is suffered as a result of a breach of warranty, the insured party will then pursue the insurer for recovery directly. This can provide buyers with greater certainty as to the source of recovery in the event of a claim, whilst also providing sellers with a cleaner exit by limiting their liability post-completion. So there's two types of W&I insurance policies, the first being a buy-side policy where the buyer is the insured party, the second being a sell-side policy where the seller is the insured party. It is typically the buyer that will take out the policy. However, just because the policy is a buy-side policy doesn't always mean that the premium is always paid by the buyer. For example, the policy cost could be split between buyer and seller, and that's usually a matter for commercial negotiation. Often we find that parties agree who will be responsible for covering the costs of the policy at the heads of term stage. Our webinar today will focus on buy-side policies, which are much more common than sell-side policies in practice. So moving on to why we use W&I insurance. There are several strategic reasons why parties use W&I and why it can act as a deal facilitator. So in terms of negotiation of warranties and limitations, whilst there will still be some negotiation of warranties and limitations under the SPA, using W&I can avoid protracted negotiations as sellers are more likely to take a more balanced approach to the warranties given the protection offered by the insurance policy. W&I can also be an attractive option as it provides the seller with a cleaner exit. We often see sellers requiring W&I as part of an auction process. This often involves the seller initiating the process with the insurance broker, and the bidder that is successful in the auction process is then required to take out the policy. You might hear this being referred to as stapling a policy to the transaction. W&I can also provide enhanced protection for buyers, as buyers can often obtain broader protection under the W&I policy than they might be able to negotiate directly with the seller. It's also a useful tool in maintaining good relationships with the seller, as it could be harmful if a buyer is raising a claim against a seller with whom they have an ongoing business relationship. Claims under W&I policies are now well established and can streamline post-completion risk management. In the absence of a policy, you could have the scenario where a buyer raises a claim against a seller, but that claim is only as good as the seller's financial standing. Finally, in terms of the gap period between a split signing and completion, where a buyer requires a split signing and completion, for example, to allow time to draw down funds, the sellers might not want to bear the risk of repeating the warranties where the split is for the benefit of the buyer. It is possible to use W&I in this scenario as a tool to reallocate some risk away from the sellers. However, W&I cover becomes complicated for interim period issues, and new breach cover is very technical. Essentially, W&I policies usually will not cover breaches which both arise and are discovered during the gap period. However, cover is often available for warranty breaches which occurred pre-signing but were only discovered after signing. I'll now pass on to Sarah, who is going to discuss what to know about W&I insurance.
Thanks, Emily. So, as Emily mentioned, and with some exceptions to this, a seller's liability for breach of warranties is typically limited to only £1. However, there are some limitations of W&I insurance that are important to be aware of. First of all, there are several limitations with the extent of the cover. One of these is that known issues are usually excluded from the policy. W&I policies only cover unknown risks, so anything identified in due diligence or disclosed in the data room or the disclosure letter is typically excluded, meaning that a seller could still be on the hook for claims in connection with those identified issues. There's also forward-looking warranties. So although forward-looking warranties are normally not accepted in negotiations between a buyer and a seller, it's important to flag that insurance only covers breaches of warranties at signing and completion and not future performance. There's also some standard exclusions, so certain risks, for example, environmental matters, are commonly excluded or only insurable with additional underwriting. There's also materiality qualifiers. So the insurer may resist covering warranties that are drafted too broadly or with minimal qualifiers. For example, warranties that ask for compliance with all laws generally, rather than compliance with only material laws. Parties will also need to factor in the cost and complexity of putting W&I insurance in place. Premiums for policies typically range from 1 to 2% of the insured amount, and this is excluding any associated taxes or fees involved. Some brokers have been in touch with us recently to advise that premiums are increasing towards the end of the year because insurers are more stretched. So extensive due diligence will need to be conducted if W&I insurance is to be put in place. If your diligence is light or if it's incomplete, this will lead to limitations on what the insurer will be willing to cover. The underwriting process will also need to be factored into the deal timetable, and although this does add an additional work stream, in our experience, W&I policies shouldn't hold up completion. There's also a process to go through to claim under a WI policy, which can often take time. The insured party will be required to prove not just that the warranty was breached, but also that that breach caused a quantifiable financial loss. So in layman terms, there's been a monetary loss which can be measured clearly. With the number of W&I claims increasing, insurers are incentivized to resolve valid claims efficiently to maintain their market reputation. So while the policy does provide comfort, it doesn't guarantee recovery of costs. There's also just limitations on recovery itself. So even when a claim is valid, recovery is not unlimited, and most policies include a retention or an excess, meaning the buyer must absorb the first layer of losses before the insurer actually steps in. The W&I policy usually has caps, which is often percentage of the deal value rather than the full purchase price. And there are also time limits on recovery, although typically we do see W&I policies mirroring the warranty claim period that's offered under the SPA. Finally, coverage depends heavily on the insurer's appetite and the market environment. When the insurance market tightens, buyers may find that risk simply cannot be insured at all or costs are increased to put a policy in place. So while W&I insurance is a valuable tool, it's important to understand that it's not a silver bullet. Understanding the limitations of WI insurance allows us to use it strategically rather than relying on it. As a general comment, a W&I policy should be seen as a complement to strong due diligence, careful drafting, and realistic expectations, and not as a substitute for these. I'll now pass you on to Rebecca.
Thanks, Sarah. Now that we've covered what W&I insurance does, let's turn to the practical considerations involved in actually putting a policy in place. W&I insurance can be a valuable tool, but getting it right requires planning, coordination, and a clear understanding of how the process fits into the overall transaction timeline. The first consideration is timing. W&I insurance shouldn't be an afterthought. To be effective, it is helpful if W&I is integrated into the deal process from the outset. Typically, it's specifically set out as a requirement in the heads of terms, which is a short form agreement of the key terms of a transaction before the parties commence diligence and drafting of documents. When drafting heads of terms, if acting buy side, you may want to make it clear that the sellers are responsible for matters not covered by W&I, who will be responsible for the excess, and it's also helpful to agree who will be liable to pay for the policy at the head stage. Ideally, the broker and insurer are brought in early, typically once a draft sale and purchase agreement or SPA is available and due diligence is well underway. If it's left too late, the risk is that completion might be halted because the insurer won't underwrite the policy until they've reviewed the due diligence and key transaction documents. Another practical consideration is coordination between the various parties involved. In any deal, you'll typically have the buyer, seller, lawyers, financial advisors, the W&I broker, and the insurer's own underwriting team, who each have an interest in the W&I policy and will require to be satisfied with its terms. Therefore, clear communication among all these parties is essential. The insurance broker in particular plays an important role in the transaction. The broker will manage the insurance process, initially seeking quotes from different insurers and then starting to negotiate the terms of the cover. The broker is there to coordinate the W&I process and should work closely with the legal teams involved. Brokers are able to provide an insight into the market. We usually find it helpful for key stakeholders in the business to have an initial call with us and the broker to answer any W&I insurance related questions. Once the underwriting process begins, attention turns to negotiating the policy itself. There are several key elements to get right. The first is the limit of liability that the policy will cover. Also, the parties within the business who are deemed to have actual knowledge. The retention or excess, which as discussed, determines how much loss must be borne before the policy will step in. The duration of cover, which is typically aligned to the warranty periods in the SPA, although again this can differ. But perhaps most importantly, the exclusions, which can vary depending on the risk profile of the business or the diligence that's being conducted. Cost is always a practical factor. As mentioned previously by Sarah, premiums usually range between 1% and 2% of the insured limit, plus taxes and an underwriting fee. There's also an element of legal costs associated with reviewing and negotiating the policy, which will need to be considered and budgeted for. For sellers, the cost may be justified by a cleaner exit. For buyers, it provides a safety net if something unexpected surfaces post-completion. Either way, budgeting for W&I early helps avoid surprises late in the process. Finally, following completion, if acting on the side of the insured party, it's important that key stakeholders in the business understand how to notify a potential claim, the evidence that the insurer will require, and how losses are calculated. As in-house counsel, it's important to make the relevant people in the business aware that keeping accurate records post-closing, especially financial and operational data, is crucial to the company's ability to make a claim under the insurance, as the insurer will want to see clear proof that a warranty was breached and that the breach caused measurable loss. I'll now pass on to Emily, who's going to chat about the importance of due diligence.
Thanks, Rebecca. So, as we've mentioned, a full due diligence exercise requires to be undertaken in the usual course where W&I is being put in place. The insurer's coverage will depend on the quality and scope of the due diligence exercise. Insurers will expect to see thorough professional diligence reports across all key areas, and the insurer will typically also have access to the data room to allow it to assist its review of the diligence exercise and the disclosure process that's been undertaken. Sellers will disclose against the warranties in the disclosure letter in the usual way, and the insurer will closely review those disclosures during the underwriting process. So, as we've mentioned, W&I insurance only covers for unknown risk. Therefore, anything that's disclosed is seen as being the buyer's risk and will typically be excluded from cover under the policy. Managing the risk for issues identified in the disclosure process are more likely to be addressed by way of indemnities or by way of an adjustment to the purchase price. If certain areas of the business haven't been covered by diligence, or if the diligence is high level, the insurer will either exclude those areas from coverage or impose tighter terms, so it's important to carefully agree with the scope of diligence with your financial, tax, and legal advisors to ensure it covers the key areas of the business and the key areas of risk. Typically, in energy transactions where diligence is often being conducted on SPVs, the key areas will be real estate, planning, regulatory, environmental, and corporate diligence. So I'll now pass back to Sarah, who's going to discuss some interactions with the SPA.
Thanks, Emily. So even though the SPA and the WI policy are two separate standalone documents, they are very much interconnected. Understanding how the two work together is critical to avoiding gaps in coverage and ensuring the policy actually delivers the intended protection for both the buyer and the seller. So first and foremost, the WI policy reads on top of the SPA. Therefore, if the SPA provides for something relating to the policy which isn't covered by the policy itself, the terms of the policy will supersede the SPA and shall apply. That being said, the SPA forms the foundation of the insurance and will only cover the warranties that have been given in the SPA. That means the scope, the language, and the quality of the warranties in the SPA dictate what's covered under a policy. And if a warranty is not contained in the SPA, it simply just won't be covered by the insurance. So a key takeaway when considering the warranties, and more specifically how they're qualified or limited, is that it must be done with insurers' expectations in mind. One of the most important practical points is ensuring that the SPA and the W&I policy align to prevent a situation where the buyer believes something is covered based on the SPA, but it's actually not because of the misalignment with the terms of the policy. Some common examples of misalignment can include different definitions of loss or claim in the SPA and the policy. So for example, the SPA might define loss very broadly and include various types of losses, including consequential loss, whereas the definition of claim under the policy may not cover such consequential loss. This would then give rise to a situation where something that counts as a loss under the SPA may not actually be a loss under the policy, and therefore you're prevented from claiming under it. Warranty limitations in the SP can also unintentionally narrow the insurance coverage. I spoke about this earlier about the varying materiality thresholds that are used to narrow the scope of the warranties and the impact that this has. And then finally, notice provisions can also differ. So the SPA might require notice within 20 days, whilst the policy might require notice as soon as reasonably practicable. If these timeframes don't match, a valid claim under the policy could be denied. The presence of the W&I insurance also changes how the SPA is negotiated because, as mentioned, the insurer takes on much of the risk. The sellers typically push for lower caps and shorter limitation periods in the SPA. And for buyers, on the other hand, they may be more flexible on certain sticking points if they have comfort that the insurance will kick in at completion. It also, however, means that insurer broker effectively becomes a third party at the negotiating table. So both the SPA and the policy will also contain notice provisions. And as Rebecca mentioned, key personnel within the business should be made aware of these to ensure a claim can be made if required. For example, if notice is given under the SPA to the seller, but not to the insurer under the policy, the insurer will likely argue that the claim wasn't properly notified. So coordinating these provisions is just as important as aligning the SPA and the terms of the policy. To sum up, the SPA and the W&I policy are essentially two sides of the same coin. The SPA sets up the legal framework for warranties and indemnities, and W&I policy overlays insurance protection on top of this framework. For the W&I insurance to be effective, both documents must be drafted and negotiated together and not in isolation. And now you pass you back on to Rebecca, who'll speak about some completion considerations.
Thank you, Sarah. There are a few key practical considerations that are required at both signing as well as completion of any transaction, and it's important to understand how these stages interact with the W&I insurance policy. The first key point is timing. When does the W&I policy become binding? Usually, the policy is conditionally bound at completion, meaning the insurer agrees to provide cover subject to certain conditions being satisfied. These conditions often include execution of a no claims declaration by the insured parties, and delivery of the final executed SPA and disclosure letter to the insurer. Only once these conditions are met does the policy become fully effective. One of the most important pre-completion conditions is the no claims declaration. This is a statement which is given immediately prior to completion, usually signed by the buyer and sometimes also the management team, confirming that they're not aware of any breaches of warranty or other circumstances that could give rise to a claim. If it later emerges that the insured did in fact have knowledge of an issue and failed to disclose it, the insurer may have grounds to deny cover. Some policies also include wording to the effect that the deal team members have read and understood any DD reports that have been issued to them, which can result in the team being held to have actual knowledge when they attempt to make a claim later down the line. So, the declaration should be carefully checked and parties should avoid signing it until they're satisfied that no new issues have come to light since the underwriting process. Directors and managers who will be required to give the no claims declaration should be made aware of and given advance warning of this requirement to streamline the process. Where there's a gap between signing and completion, it's also important to manage interim updates. The insurer will usually require confirmation that there's been no material change in the target business or its warranties during that period. As Emily mentioned, W&I cover can be complicated for interim period issues, and new breach cover is very technical. If something does arise, for example, a new legal claim, a regulatory development, or a significant operational event, it must be disclosed to the insurer. The insurer may then adjust the policy terms, exclude that issue, or in extreme cases, decline to bind the policy. However, it is more common that the policy will not fall away entirely. So regular communication between the deal team, legal advisors, and the insurer is essential during the gap to ensure that everyone stays on the same page. Typically, the SPA, disclosure letter, and insurance policy or binding confirmation are all executed around the same time. Because the policy is contingent on the final form of the SPA, the insurer will usually want to be kept updated with each new version of the draft SPA and receive a clean copy immediately upon signing. In a split signing and completion deal, the completion disclosure letter should also be sent on to the insurer as early as possible. It's good practice to prepare a short signing checklist setting out exactly what needs to be sent to who, including the insurer, the broker, and the relevant legal teams. That ensures nothing falls through the cracks when various documents are flying around on signing day. After completion, a few follow-up actions are worth noting. The first is to make sure that the insured party retains copies of all final deal documents, including the executed SPA, disclosure materials, and the W&I policy itself. It's also good practice to keep a record of the communication trail with the insurer. This can be invaluable if a claim arises later. And finally, it's also good practice to diarise and take a note of the notice requirements and policy periods, so any potential claims are notified within the correct timeframes. I'll now pass on to Emily, who's going to speak about W&I for the energy sector.
Thanks, Rebecca. Deals in the energy sector are unique in nature, and as we've mentioned, the diligence process tends to focus on key areas such as real estate planning and regulatory risk. Even within the sector itself, different transactions have different risk profiles depending on the asset being sold, whether it's an onshore or offshore wind project, a battery site project, or an upstream fossil fuel exploration deal. Underwriters will closely consider the type of transaction and asset being acquired when it comes to assessing the risk and the pricing of the product. The W&I market in the energy and infrastructure domain requires specialist sector experience, and so it's important the insurer has an understanding of the energy sector and the risks and regulatory regimes relevant to the business. The broker will play a key role in navigating the market and making sure that the insurer and the policy is the correct fit for the transaction. Helpfully, some W&I insurers explicitly list energy or renewable energy as a sector focus, and insurers and brokers are providing specific solutions or product innovations tailored to energy and infrastructure transactions, including W&I combined with other contingent risk, environmental, or tech warranties. So some key practical considerations for W&I deals in the energy sector include, because energy deals are often large asset values, multiple jurisdictions, technical operational risk, and longer-term liabilities, the W&I underwriting process may be more rigorous and possibly more costly than simpler transactions. For renewable subsectors, including wind and solar, where technology is more mature and risk profiles are better understood, obtaining W&I cover may be more straightforward, whereas for emerging technologies, for example, including hydrogen, where there is less data to support the risk profile, it may be more challenging to obtain W&I coverage. I'll now pass back to Rebecca, who's going to give us some market insights.
Thanks, Emily. Generally speaking, our current experience is that the market for W&I insurance is a buyer's market. We are seeing good coverage for reasonable costs. At times in the past, we have seen premiums going up towards the end of the year because insurers are at or nearly at capacity. There are many examples of where W&I insurance can be used for the energy sector. One example of where it can be used strategically is the development of an onshore wind farm. These have seen an uptick in M&A activity over the last year or so, following the UK government lifting the de facto ban on new projects in England. Also, the recent grid connection reforms have generated an increase in M&A activity, and we're expecting that to continue. This will also have an impact on the W&I market for the energy sector. These are just a couple of examples of the energy market evolving and illustrates how W&I can provide a solution to a suite of risks that investors and developers may anticipate when looking to expand into the sector, whilst also allowing access to the critical investment needed to give projects the green light, without taking on unnecessary liability. The energy market is broad, as Emily mentioned, covering both asset and share deals across a range of jurisdictions. Generally, we are seeing an increase in the use of synthetic coverage, for example, synthetic tax indemnities, whereby a tax indemnity isn't negotiated between buyer and seller, as would usually be the case, but is agreed directly between the insurer and the buyer. It's important, however, to be aware of the additional cost attached to policy enhancements such as this, but it may particularly suit transactions in the energy sector, where there are various shareholders or joint ventures, and the parties aren't as willing to stand behind certain warranties or indemnities. Brokers have also highlighted to us that there are a number of new entrants in the W&I insurance market, which has increased competition among insurers and may help to keep costs down. After a slightly softened market in 2024, we understand that the W&I market has had a busier year in 2025. And as mentioned, although this can sometimes result in an increase to the cost of premiums, it just goes to show how many buyers and sellers are recognising the value of a W&I policy to their deals. I'll now pass back to Emily, who's going to close us out for today.
Thanks, Rebecca. So that brings us to the end of today's session, but if you'd like to hear more about any of the topics we've covered today, or if you have any specific queries for us, please reach out to one of us and we'd be delighted to hear from you. So as discussed, our session today has been recorded and you will receive an email with a link of the recording of today's session early next week. In that email, you'll also find a link to register to the final session of our 2025 programme and learn more about the programme generally. Our next and final session for this year is on Tuesday, the 16th of December, and it will focus on life extension and repowering of projects. So please do use the link to check out this upcoming session and book your spot in advance. And finally, thank you very much for joining today's session, and we look forward to seeing you at future sessions.